Welcome back to Trading 360. I'm Nicole Pedalides. It's time for the big three. Three stocks, three charts, three trades. Rick Ducat will take us through the charts. Here to take us through the trades, Don Kaufman, co-founder of Theo Trade. Great to see you both this morning. Don, before we get to some of the names that you're following closely, just your thoughts on, look, we're now having a winning week on Wall Street. What do you call this kind of move higher? How are you describing it?
One word, manic. I mean, the marketplace right now is still in the midst of pretty serious volatility. This just happens to be a rip back to the upside. I'm sure you've heard me say this before, Nicole, but this is the quintessential rip your face off rally. And right now it is. It's just still, some manic trade. And again, I don't want to rain on anybody's parade because it is back to the upside over here. But, if you're looking for a place right now where you need to get out of the marketplace, this could be your opportunity because this volatility, it's not going to abate, not yet anyway.
Right, so sell on the rallies rather than thinking it's going way higher because you expect more volatility, I guess. Tell me about Nike and why you're bullish on this name.
Yeah, so here's a change of pace for me. Getting a little bit bullish, right? One of the first things I'll discuss with Nike is just on a pure technical level. You have multiple year lows in and around the 52 level on Nike, and you got a question. Is that it? Is that ultimately going to be the bottom? And this trade is largely predicated on exactly that. Looking at the 52, level, looking back many years and assessing, it's very likely, at the very least, a short-term bottom may be in. We actually traded around this level for a considerable period of time. Nice base of support. We're rallying off of it. Looks like an easy entry to an upside opportunity, but I'm still going to take this with a grain of salt and define my risk using a spread. So I'm going out to the June 20th expiration. Very often lately, because of some of the volatility, I have to give myself duration in some of these option trades. June 20th expiration, I'm going to be buying the 65 calls, selling the 70 calls. So it's a $5 wide spread. The spread is done for a 90-cent debit. So cheap shot to the upside. But if we actually, have a little legs in Nike off this 52 level, we could easily get back to that 70 level.
Yeah, I mean, look, it was almost 100 a year ago. Let's see what Rick says about the chart, please, Rick.
So we're in an interesting situation on this particular chart here. And what I mean is that we had a gradual downtrend that accelerated and steepened into a much sharper downtrend that seems to have, for now, bottomed out near 52.28. Now we can see that price is breaking above that shorter term white trend line here and bumping up against not only our previous highs, but also our yellow 21-day exponential moving average, both of those coming together right around 59.50 or so. So this would be a key area for price to overcome. If it were to do that, then we would be looking to fill our gap, or the bulls would be looking to fill that gap, 64.16. So pretty close to the strike on Don's trade there. So if we were to also look at RSI, our momentum indicator, we are out of the oversold area. We are traveling upward. We made new relative highs, still a bit short of that 50 midline here. That would be the next step that the bulls would want to see to the upside. If we were to look at our other studies, standard deviation channels and volume profile, we can see that there were some takers here at these low price levels here. So there was a bit of a volume node that developed, and we are pushing back above it now. That volume node comes in right around 56. So 59.50, that's our confluence, then our gap, 64.16. Volume profile point of control, though, all the way up here, 76.54. And a quick look at our 5-year longer term chart. As you can see, as Don was saying, very depressed price activity here, but we are coming in at our -1 weekly standard deviation channel. So this could be a supportive area to consider right around 55 or so.
All right, thank you for that. And look, people, are also reportedly just buying sneakers ahead of the tariffs really kicking in because they're worried that their Nike sneakers may cost more. I thought that was interesting. We did see a buy rating from Williams Trading. They have a $73 target. Goldman Sachs with a buy on the 22nd of April, a $72 target, so well above where we are now. Let's turn your attention now to JPMorgan Chase, where you've also turned this arrow in a different direction. This one you're feeling more bearish. Don, tell us more about that.
Yeah, absolutely. The financials, there's still a lot of headwinds in place right now. So do you want to look at like, consumer credit that's ultimately deteriorating? Is the US still the possibility of facing a recession? I know that's not a popular topic of conversation when the S&Ps are up, a few hundred points in the midst of 2 days, but recession is still possibly imminent. Maybe we're already in one right now. So between consumer credit, there's not going to be a lot of IPOs, so your investment banking is basically dead. M&A is probably dead right now. And as I said, there's a lot of economic headwinds. One thing they have going for them is possibly on the balance sheet. Some of the trading right now is extraordinarily active at many of the banks. Nevertheless, I am going to take a little bit of a bearish shot, and I think that this rally over the last 2 days is the opportunity to do just that. Here's one I'm actually going to jump all the way out to the July 18th expiration. As I said earlier, I'm looking for a little bit of duration on here. I may not be right in this volatility today. I may not be right tomorrow. Give me to July 18th for the banks to deteriorate. I think we're there. I'm going to buy the 230 puts. I'm going to sell the 220 puts. $10 wide put spread. This one's done for a $2.80 debit. A marketplace, you need a new word for volatility. This is just chaos right now. That chaos is going to come back to roost, and I think in the financials is going to be holding the bag of risk.
Chaos, manic, volatility. I used the word turbulence earlier today. All right, what do you think, Rick, about the chart?
So that general area between 220, 230, that's a point that I had my eye on as well, because it represents a series of old highs here. So this green line is about 225. Notice how we had a very notable ceiling here that we eventually did break out to the upside. Then we hit a low point there once again, and then we had our tariff-related chaos, turbulence, whatever you guys want to call it, down here that we did recover back above. So now we have our purple 252-day exponential moving average in line with that old resistance level that now becomes supportive. So right around that same general area that Don was discussing is an area that caught my own eye as well here. Today, though, we can see that price is breaking above this downward sloping trend line here, as well as our yellow 21-day exponential moving average. So that was the first phase of the breakout here. The next point is that we're breaking above our 63-day EMA as well. Both those points respectively, 235 and about 242. We can also see that RSI is pushing above that 50 midline here, so perhaps another bullish signal being generated for now. We can see if we were to add our other studies, volume profile and standard deviation channel, the area where we are now has even greater emphasis because it's our point of control, the area of heaviest trading. So this now becomes a potential supportive area. If price were to retest it, that would be crucial for it to hold on to this level near about 242. To the upside even further then, 254 perhaps, a high point here, low point, and subsequent high points there. That could be another area to watch. And then, as I said, to the downside, 225.
Okay. Thank you for that. I mean, what are your thoughts on rates and the rate environment and all these financials, Don, before I move away from JPMorgan and those names?
Yeah, the rates overall, I actually would believe that the 10-year is capped. You're starting to get above like 4.5%. If we get back up to those levels, everybody's going to get nervous, including, of course, Jerome Powell. And that's might be the pressure he's going to need to turn some of the rhetoric and kind of pivot to lower rates. So I would definitely put a cap in and around the 10-year, right around 4.5%, big round number. We're not too far off of it right now. So anticipate rates are probably going to be considerably lower by the end of the year. And I would say that the number of cuts over there is not fully factored in just yet. And you could see some significant cuts, especially if the economy starts to deteriorate a little bit further.
All right. Okay. I'm writing that down. And last but not least, how about emerging markets? You have the ETF there. You're bearish on this one, Don.
Yeah, I'm bearish on the emerging markets right now, predominantly because I keep hearing again the voices in the market. They're like, anywhere but the U.S. And that's been anything but true over the duration. So I'm not buying outside of the U.S. I'm just not buying it right now. And heard German markets, Asian markets, which is predominantly EEM. In this, I do want to short. If we do start to get a kind of a cyclical recovery in the U.S. dollar, I think you have to expect that the EEM is going to take a little bit of a hit. As such, this trade's a little shorter duration. So this is kind of the here and now. I think if the EEM is actually going to roll over, again, it's going to be here and now, but this is the May 23rd expiration. I'm just going to buy the 44 puts, sell the 42 puts for a 73-cent debit. This is what I term an in-out spread. It's just to kind of control volatility, okay? Get me into a position that's, like risk a buck, kind of make a buck kind of position. Again, predicated on the idea that there's going to be strength in the dollar in the near term, and people are going to start to turn around and be like, did I really go out there and just say buy everywhere but the U.S.? So look for emerging markets to pull in a little bit.
All right. And look, maybe the softer Trump trade policies that are emerging here right now may bring more money back to our markets here at home.
Sure.
Rick, your thoughts?
We're at an interesting point on this chart as well here, and I had my eye once again on some pretty similar price levels from a technical perspective here. So just to start out with, this is around where we started having a lot of the tariff-related news flow and kind of the start of this rather volatile, to say the least, period here. So that was right around 43.71 is where we started seeing our gap down, so pretty close to that 44 level. Now, as well, we also have 41.50, this green line here. That was the high point after one of our big gap downs. Then we hit our lows down here. We rallied, and then we retested that 41.50 point again before continuing the rally. So old resistance became new support, and that's a downside area to consider. In the middle of all this, we have our three moving averages clustered together between about 42.37 to 43. So we have a situation where when the moving averages are coming together and flattening, it suggests either a sideways range-bound period or that prices are so choppy that the moving averages are unable to really show a clear direction. It's probably more of the latter, given these dramatic swings that we've seen recently. Nevertheless, 44 to 41.50, kind of the general area of interest here. We do see RSI breaking to the upside above its trend line and that 50 midline here. But when we are also to include our other studies here, we can see that we are kind of stuck in this volume node here still. We haven't really pushed out of the heavy volume area and had the breakout yet. We can also see that our blue linear regression line, our line of best fit, lines up with our old resistance. So right around 43.75, 44, once again, that's the resistance point to watch. Then to the downside, we can see that we have our point of control and our 21-day EMA just a bit lower. So around 42.45 or so, that would be another potential stopping point on the way lower to 41.50.
All right. Well, thank you for that. I mean, year to date, EEM up 3%, while the Nasdaq's down 10% this year. Thank you so much. It's great to see you both. John Kaufman, Rick Ducat, a good luck there at Nike, JPMorgan, and the Emerging Market ETF. Thank you, Emerging Markets.